Hello everyone, it's me the Boss Hog, and we're back for another portfolio update over Easter. I am still away with my family in Poland, so it's going to be a fairly quick portfolio walkthrough today. It's been a difficult week, honestly, but I feel like it's important to update, share this graph, which I've previously been very positive about, feeling less positive about this week as my portfolio gets beaten up and I underperform the market over the last few weeks. I'm going to talk about why, how I'm feeling, and then walk through the portfolio. Let's do it. All right, so in terms of how we're doing, our portfolio value here of 125,493, definitely a significant fall since last week, and that's despite the fact that I've added some money for the new tax year, which feels good. But ultimately, we are buying into a falling market, or at least a falling portfolio at the moment. We do still remain profitable, but again, a far cry from where we were a few weeks ago. This is now our 14th week of doing these weekend closings, so we are now going to be able to have a rolling quarter and see how we're doing. And yeah, broadly speaking, a little bit disappointing week. It was weirdly consistent between Monday and Wednesday. I basically lost £1,500 a day for 3 days. And then Thursday, I managed to put a little bit of life back into the portfolio. So a challenging for sure. You can see here that my trading 212 profit, so this is my brokerage of 75, my Google Docs profit of 395. I swear there's something weird that must happen with Google on Friday, because during the week these figures are a lot closer, like often they're less than £100. And then for whatever reason, when I do these weekly updates on Fridays, it seems to have ballooned again, if that's quite the right number to talk about, considering it's only £300 apart. But yeah, so again, we continue to monitor this anyway, just to make sure there's no mistakes in my spreadsheet. And it's important, obviously, that we reflect our portfolio value over here from Trading 212. But most of the numbers in here are reflective of Google Documents, just because I have better ability to do analysis. This is now real data on our little target chart here. I don't even know what to call it really, but yeah, this is a new tool that I have, so we're going to be able to monitor how well we're doing over the year. I did 800. I don't think I'm going to be able to do too much more until the 20th when I get some more money. But you know, we remain about 3 weeks ahead of ourselves as a result of this. Basically, the plan is to basically use each month's paycheck to buy shares equivalent to sort of about £3,200 a month we need to do in order to hit our targets. So we'll see how the year goes on. For anyone who's watched my last couple of videos, I've been talking about sort of adding to wealth and all the rest of it. And I am quite pleased in a way that we're running a few weeks ahead of schedule at the moment. So that feels really good from that perspective. What feels less good is that even though I'm still profitable, and even though sort of I had a difficult 2022 like the rest of the market, it was sort of better in a way because at least I was outperforming the market. Now it feels like I've been dragged back down again. Now, in fairness, I'm trying not to think of this as too sort of short-termist, just as I wasn't getting hugely excited in January when I pulled ahead of everything. So I'm trying not to get too, unmotivated now. There have been some challenges also in terms of FX. Like I played around with these numbers, just, if like the dollar to pound was more like 120, then I'd be back ahead of the S&P. If it was 115, I'd be ahead of the FTSE 350. So like the FX has a relatively big move on this as well. And at the moment, I'm sort of surprised at the exchange rate for sure. Outside of that, I've also been using the current situation in the markets to buy into bank shares, growth stocks, tech more generally. So I do feel like I'm buying a lot of underutilized sectors at the moment. I probably got into them, a little bit too early with perfect knowledge. But for me, it's still a great opportunity to be buying stakes in these kind of segments. So again, I'm trying to not be too discouraged from very narrow sets of data and just kind of trust the process. So just as I was sort of managed to get to grips after the big fall over here related to Ukraine, so I'm trying not to overthink it and sort of trust myself to bounce back over the next few months. So we will see anyway, obviously, and I will do my best to keep bringing these on a weekly basis. I did do a little bit of selling this week. We also got some dividends this week, so that felt pretty good. And yeah, it was outside of that, most of the portfolio fell back. So like I say, deposited £800. So without further ado, let's have a little look at what I've been buying. So my £800 was split across two things. The first one being Scottish Mortgage Investment Trust. I continue to buy into this quite heavily. It is my fourth largest position, although only just between fourth and fifth. And again, for me, I am about 8-9% red on this. I have like a 730 average price at the moment. But again, we are very happy to be averaging down on this, and I'm going to keep following it down basically. I remain relatively bullish about the general direction of SMT. Although they have 30% private holdings, for me, that's not a problem. Most of their private holdings, especially by value of their portfolio, are in massive companies that I'm really grateful to have a part of. I'm particularly excited about Northvolt, I would say the primary European UV play, basically. So we'll see how that goes in the future. But yeah, that will be excited. Sorry, I think I said UV there. I meant EV, obviously. Next up, we have a slightly more controversial buy, which is maybe £550 into our bank-focused ETF. This is a bank ETF that's split 1/3 majors and 2/3 regionals. Obviously, at the moment, this is quite a interesting thing to be buying. But again, I remain quite convinced in the long term of financials. My position here is basically about 430 at the moment. So again, I got in a bit early, but you can never, or you rarely time it perfectly. And my position now is just to keep buying anytime it's under $4, basically, to build up this position. Don't know exactly when I'm going to start. But yeah, happy with the size of this position at the moment. So it feels pretty good there. If I just scroll a bit further down, I did do a little bit of account movements as well. So I moved these three into my wife's ISA technically. So it's a bit of a rejiggle. I did technically make my 92p, but I've just left it in cash in my non-ISA account. So it's not kind of recorded here. That's fine though. So we've got moved into IC. Yeah, it was only £250 across all of them. I made a very small amount of profit, which has already gone into sort of being down on these positions. Again, here, my plan was to sort of follow up on some feedback I got from my conversation with ChatGPT and effectively plug in some gaps in my portfolio by adding to these ETFs over time. So my wife's portfolio, which is, I would say, lower risk than mine and certainly less cyclical, is where most of these things are going to be going, and we're just going to build them up over time. So my personal ISA has sort of SMT and banks in, so we'll again buy into those also as a sort of higher risk and more variancy kind of play. It's also got most of my semiconductors in as well, so Amcor, Micron, and ASML all sit in that portfolio. So again, it's very sort of cyclical and higher risk, I would say. So that's not deliberate. It's kind of just been how it's shaped out, but it is what it is. I also decided, I originally wanted to keep £1 in each one of these just to keep my positions active, but for whatever reason, my brokerage just sort of rounded it up and made me sell all of them. It's kind of okay. I only had sort of £500 in each of these and had been selling them down already to buy into a couple of other things. So I was up very modestly on both of these positions and decided to, yeah, just buy a little bit more. I did also receive some dividends for T Rowe and Huntsman. So I just averaged back into those basically as well, just continue to drip basically into them. I'm quite confident with Huntsman. It's been for an interesting period. I am quite red on this at the moment, although overall, because I made so much money on them previously, so my realized sales basically are extremely green. So we're still up on our net position, but our unrealized position is quite red by about sort of 14%. So that's not the prettiest. But again, I'm more than happy to buy into Huntsman and just keep on reinvesting the dividend. Similarly, as well with T Rowe, I got a dividend from them and I just put it back straight back into T Rowe again. We're more than happy here. I'm actually not even that red on T Rowe, a combination of sort of favorable FX when I first bought into this, as well as sort of just being down very slightly. So I think I'm only up a couple of percent down on T Rowe, and I'm hoping it's going to turn green. And I suppose actually just while I'm talking about positions that are turning green, it's worth just finding Facebook. So I've had Facebook for a little while. I thought I got a relatively good buy previously, but obviously it's been through the ringer a little bit. But actually this week I managed to turn green. So this is a nice surprise for me actually to be just very slightly up on Meta, just by like 1%. My position here with Meta, by the way, is that I'm still going to continue to hold it. I was buying Meta when they had a P of 18, 18 down to 15. So I think my average is about 16. And I'm relatively happy with that for Facebook. Like, this isn't some speculative tech. It does have a very good money-making mechanism. To be honest, I won't be sad if they decide to ditch the Meta side. I view it as kind of a a gamble, and if it doesn't work out, I've still got a reasonable position in a profitable company, and if it does work out, my position looks extremely cheap. So I did think about sort of selling this and sort of getting rid of Meta, because when I first bought it, I wasn't even that infused about Meta, to be honest. It just seemed cheap at the time, considering the sort of risk-free nature of Meta for the investment. And I still kind of take that viewpoint. So even though I'm not a user of Meta, it still feels like a company that I should have. And we'll sort of just reassess over the next half a dozen quarters and decide if it's going to be a long-term position or we just take the money and put it elsewhere, basically. So that's my sort of thoughts on that. So just to cover that why we're doing it as well. Outside of that, our sector breakdown continues to look very technology led, especially once we split out our ETFs, which now account for almost 30% of our overall ISA portfolios. So yeah, it's pretty amazing to see that growth. When we break it out here, this is an imperfect breakout. What I do is I look at the largest position in each ETF and basically put it into the relevant sector. For some of them, it's very clear. For things like banks, obviously that ETF is all about financials, even though for like HCAN, which is my Canadian focused ETF, that's like 43% financials, and it's more than double the next segment. So again, I think it's okay to class that as a financials. Other ones are a bit more up for debate. Like I have an S&P, high growth one that is focused on smaller companies. So if I just find it here, this IDP6, this is extremely close between industrials, technology, and financials. And at the moment, interestingly, industrials are just very slightly ahead. But it does, you can definitely sort of pick holes with the method being used here. But it's my method, my portfolio, so I'm going to do it anyway. And I think, to be honest with you, an area I'd still like to continue to grow is healthcare. But again, my current ETF healthcare is around flat, and it just feels like there are better buying opportunities for me at the moment. But I think, again, this is another one in my wife's portfolio. So I think I'm sort of just going to dollar cost average in almost kind of blindly and just sort of trust the process with a few of these, like the healthcare ones, like the consumer discretionary fund, although here you can see this is my W cost. So currently I don't actually have that. But again, I think for some of these, I'm just going to sort of average in over time and again, just trust the process. And if, as and when that particular segment crashes, then we can look at doing a big shopping spree into it. But until then, it's no bad thing to be sort of making my portfolio a bit more diverse. It's definitely weighted in certain directions, clearly technology in this case. And yeah, financials, which again, I continue to want to grow. Our dividends got off to a relatively good start in April, but underperformed in March. But that's mainly because we just didn't get those last couple in for March. So not too disappointed with that. And February and January were running miles ahead of where we were previously. We got a couple of specials, interestingly. Games Workshop did an extra one previously. And Hollywood Bowl also did a nice, pleasant surprise special dividend as well, which is a company I think is hugely undervalued at the moment, frankly. So yeah, I'm very excited about our dividends by year, which is when you get to see it sort of spread out quite nicely. And I'm relatively confident we should comfortably hit more than 3K this year. And likewise, we're starting to get into a bit of a pattern with our dividends as well. Like my first year was a little bit sporadic, and I had a heavy US weighting. So it tended to do quarterly dividend payments spread out because of the nature of US quarterly dividend payers. But then from 2022, I basically started to shift into more of a UK focus. I wish I'd more exaggerated that. I think it would have been better for my portfolio. But, again, we went with with the approach we did. And because they have sort of a much heavier interim and final, so just 2 dividends a year, we end up with this kind of a slightly different pattern. So it'll be interesting to see again whether Q2 for this year is going to be really awesome as well. But yeah, we'll see how that shapes up basically. So it looks like it's going to be fantastic looking ahead. These are projections at this point. And the reason why it was so high last year is because I got a big special from Aviva. This year is just because, we've grown a lot of our UK holdings. And so that's going to be a particularly great quarter by the looks of it. So yeah, continuing to trust the process in effect. Obviously disappointing that we're underperforming the market quite substantially at the moment. At least since sort of February and March. Again, it's only 2 months. I clearly have a very tech and higher risk focused portfolio. So we are mentally managing as best as we can, and hopefully we'll be able to bring some better news in the near future. Anyway, that's all I have for today. A relatively quick video by my standards and a little bit of a walkthrough through the dividends just because we had some time. Thank you very much for watching, everyone. Enjoy your Easter, and we'll be back to sort of proper videos next week. And I think I'm going to do a review of either Amcor or Gamma, my two largest holdings, both of whom had results, and I would say both of whom disappointed the market. So we're going to sort of review those in a bit more detail in the very near future. So something to look forward to. Anyways, thank you again, and bye for now.